Hello, my name is Naomi. Let's begin this session with a word of prayer. Heavenly Father, we thank you for gathering us together. We acknowledge that you are our source, our provider, and the giver of every good gift. In this time of learning and growth, we invite your presence to lead, teach, and strengthen us. Lord, as you promised in Joel, answer us with wisdom, understanding, and clear direction. Open our minds to receive knowledge and our hearts to apply it with faith. Lord, restore every area where there has been loss, lack, or discouragement. Restore our confidence, our resources, and our hope as we grow in financial stewardship. Lord, cover us with your favor and protection. Guard us from fear, waste, debt, and unwise decisions. Help us to walk in integrity and discipline in all that we do. Lord, provide for every need represented here today. Bless the work of our hands, open doors of opportunity, and teach us to be content, generous, and faithful with all you have entrusted to us. As Jesus taught in the parable of the talents, help us to be faithful stewards. Give us the wisdom to manage well, the courage to invest what you have placed in our hands, and the diligence to multiply every gift, opportunity, and resource for your glory. May each session draw us closer to your purpose, equip us with practical wisdom, and transform our financial habits. We thank you because you answer, you restore, you cover, and you provide. In Jesus' name we pray. Amen.
Welcome back. Last week, you were equipped with the tools that create financial stability, tools that protect you, strengthen you, and prepare you for growth. You learned how an emergency fund keeps you steady, how compound interest rewards consistent habits, and how wise vehicle decisions keep more of your money working for you. These steps aren't just information. They're the foundation that frees you from the cycle Proverbs 22:7 warns about. Some of you have already started putting these tools to work. Some of you are still deciding when to begin. But here's the truth. Once you apply what you've learned, you unlock the capacity for your money to grow. Not just slowly, but powerfully. And that's where today takes us. This week, we shift from stability to accumulation. You'll learn how investing builds long-term growth through index funds, diversification, and risk management. Think of it like planting a financial forest. One seed is good, but a forest multiplies. Wealth doesn't appear by accident. It grows when you take action. You've been given the tools. Now it's time to use them. Your financial forest is ready to be planted.
So what we're going to do is we're going to bring Belinda up so that she can do her teaching moment. I'm also going to put the QR code up to give everybody ample opportunity to get into the session.
Alrighty, how y'all doing tonight? Wonderful. Everybody doing okay? Good. Y'all ready for some more? Yes. Some more. We're gonna chew on some more today. A lot going on, as you guys well know. And I'm gonna do something a little different than I had originally planned, but we're gonna get it all together. How did this week go, financial? Have everybody started doing what they're supposed to be doing? Okay, y'all saying yes. All right, that means y'all ready. Most of us have heard the old adage, don't put all your eggs in one basket. It's simple, practical advice. Whether it's an unexpected car repair, job change, sudden dip in the market, life has a way of throwing curveballs when we least expect it. Let's take a look. So let's say this is our basket, and we put all our money here. Everything, all of our resources have been channeled into one place. But then life happens. And sometimes when life happens, the whole basket falls. And when the basket falls, then so do some of our hopes and some of our dreams. They just kind of fall all out. And we wonder, what do I do next? The eggs are all broken. They're cracked. And now when we lift up the remnants, we have the yolks of broken dreams that we can't recapture because they're gone. Because now life has happened, and we need to take those resources that were in this basket to take care of life happening unexpectedly. And we know what some of those things are. Maybe I lost my job. Maybe one of my kids got hurt in a car accident, and we have some unexpected medical bills. Maybe my house caught on fire, and I got to pay deductibles. Where is it all going to come from? It's going to come from that basket right there. That one basket that you've put all your hopes and all your dreams in. That's not the way we want to live. That's not why we're here today. Nicole, can I get you and Peyton to come up here for a minute, please? And Peyton, just stand right there for a minute, and Nicole, you stand right there for a minute. Long before portfolio theory, index funds, or Wall Street risk algorithms, 3,000 years ago, King Solomon captured the single most effective rule of risk management by putting this exact same practical wisdom into Scripture. In Ecclesiastes 11:2, we find, invest in 7 ventures. Yes, 8, for you do not know what disaster may come upon the land. He's given us 2 solid principles for real life. Protect your family, spread your savings across different areas so that if one basket drops, your whole financial house doesn't come falling down. The second thing he says is that we need to stay humble, that none of us can predict the future or guarantee what the economy will do tomorrow. Think about that for a moment. In a world obsessed with timing the market, hitting overnight home runs, or chasing speculative hype, ancient wisdom points us towards a very different financial framework. One built on active stewardship, deliberate diversification, and patient compounding. When we align investing with biblical stewardship, we shift from gambling on unpredictable markets to preparing for them. Today, we're going to examine how these timeless biblical principles don't just hold up under modern economic conditions. They give us proven framework for building resilient wealth. And let's see how that can work out. And you stand over here, Nicole. Why don't you come on over here, Peyton? So we're going to look at some of the things that we can do to help diversify and be prepared the way that Solomon has expressed that we need to be prepared. That's one of your eggs right there. CDs. See that one? It says insurance. IRA. Stocks and bonds. High yield savings. Mutual funds. .401k. All right, so we got all these things here. That one's growing. That one's growing. That one's growing. What we got on here? That one's growing. That one's growing. Two more. That one's growing. Now you see, we had one basket with all the funds in it. And when the bottom dropped out, we had nothing left. But when we used diversification and we spread it out like Solomon said, he said 7, yes, even 8 ventures to protect your family, to protect your home from unexpected life happening. And while this basket may have fallen, you still got all these other things that are growing exponentially. They're not all growing at the same time, but they're all growing. Each one of them is accumulating wealth for you. This is biblical wisdom. This is how it works. You can't venture ahead if you haven't followed the precepts that have been set out over these last several weeks. Okay, y'all chewed on what we did in the past. Now we need to start looking at how we're going to accumulate wealth, providing safe haven for our families in the future. So building real financial peace isn't about getting rich overnight or guessing hot stocks. It's about taking faithful, steady, everyday steps to protect and grow what you've been given. What you've been given. Because every one of us has something in our hand that God wants to bless. We have to submit that to Him and follow His advice so that it will grow. He knows exactly what we need. He's waiting for you to offer it up to Him. So that's what we're going to talk about today. Timeless practicals, practical ways to put timeless wisdom to work in your financial life. So let's lean in and listen.
Good teaching moment. So as you can see, the QR code is up. If everybody that has just walked into the room, go ahead and get themselves locked in. We're going to do a couple of scenarios before we get into the lesson. We've got a lot of information on investing, and I want to kind of take my time with it so that you get the full understanding of the 3 things that we'll talk about today. So I'll leave that up for another moment or two. In the interim, though, I really want to give a praise report, and it's really not my praise report to give, but I'm going to give it anyway. Peyton, I've been working with Peyton for probably the last 2 years on her finances. Yeah, it's been 2 years, Peyton. So she reached out to me over the weekend, and she said, hey, I got my credit card, and it's up my limit to a certain dollar amount. And so instead of me saying what I would normally say, okay, Peyton, you don't need to be using the credit card, I just simply said, what do you want to do with it? She came back and she literally said, I think I'm just going to leave it where it is. So she's had some significant growth over the last 2 years. There was also another praise report, but I'm not going to give hers. I'm going to wait for Jody to get here for her to be able to give hers. It looks like we've got a few more people coming into the room. We will allow them to log in, and while they're logging in, I want to share something with you. One of the things that we talked about when we first started this course was that the way that God does things is he generally puts everything in the Bible 3 ways. He does it spiritually, he does it emotionally or through your mind, and he also does it practically. And so when we think about the parable of the farmer scattering seeds, when you read that, it really is about your spiritual well-being, your emotional well-being, but you can superimpose that over to your financial well-being because it talks about the different places that your seeds can end up. If it ends up on shallow ground, then maybe you're trying to do an investment that you really haven't researched. So that thing is going to dry up, you're going to lose some money. Sometimes it falls into a rocky place where, you may have gotten a tip from somebody. That tip may not have been all that great. Initially it's growing, and then all of a sudden it disappears on you. And then you might get into a situation where it's falling into fertile soil. That's where you want your investments to go. You want them to be planted in fertile soil so that you can get your 30-fold, your 60-fold, or your 100-fold. So what I'm going to challenge you to do to see whether or not you believe me when I say that all of the principles on earth are pretty much well defined in the Bible is when I finish the lesson, I want each of you to either accept or reject that the principle, especially the scattering of the seed, falls in line with your investment strategies, because we're going to pretty much keep that same thing. You'll see that I am going to continually hit the same point because I want you to be able to understand that when you plant your seeds in good soil, it will grow, but you have to be patient. It's not about getting your money quickly. It's really about giving it time to grow. So is everybody in the room logged in? Oh, so they didn't join the first time. So, okay. Yeah, because they didn't join the first time. So they won't be able to because the session is closed. Okay, so we're going to go ahead and we're going to start a little voting. This voting is really going to be about decisions when it comes to buying a house. So I'm going to start the voting. You're going to have about 120 seconds to vote. Ready? It's asking you what your down payment strategy would be. Only got one vote so far. It's important that everybody votes so that we can get a good indicator of how the room is feeling. Nicole, can you help Ms. P log in? Pull your screen down. You should be able to see the vote. The people that are online, you can go ahead and vote if you're part of the session. And if you have any questions, make sure you put your questions in the chat, and we will address your questions tonight. Got about 30 more seconds. We got 12. Come on. Do a few more. Now, one of the things that we were able to do from the last session, the developer was able to reprogram the back end of the program. So basically, whatever decision you make, even though it's a collective vote, you will actually see how that's affecting your spending, your debt plan, and your joy plan. So
90 voted for the 20% down payment with no PMI, while 3 chose the FHA loan with just 3.5% down. That split shows a clear preference for avoiding extra insurance costs, but with some room for a lower upfront cash outlay. 22 did not vote, so they get the majority choice applied to their numbers, while each voter keeps their personal decision. Putting 20% down means you're saving yourself the monthly mortgage insurance, an extra cost that can quietly drain your budget over time. In biblical terms, this is about avoiding unnecessary debt, like Proverbs warns against the surety of a stranger. Think about this. How much could you save over the years by paying up front instead of adding insurance fees? That calculation will ground your next move firmly in stewardship.
So does everybody understand what PMI is when you're buying a house? Does everybody understand that? So basically, when you buy a house, it's best to go ahead and put 20% down so that you're not charged any of the insurance premium because you didn't put enough money down. But here's the trick. Once you start to make a payment, if you don't put 20% down, once you get to that 20% of what you've paid against your mortgage, you can reach out to the mortgage company and they will remove the 20% as far as the PMI insurance. If you don't, they'll just continue to collect it. So it's best for you to monitor your mortgage. Once you get to over 20% of what you've paid on that piece of property, reach out to the mortgage company and they will remove the PMI insurance, okay? And that's going to save you quite a bit of money because otherwise you're going to carry it for the entire life of the loan. So if you've got a 30-year mortgage, you're carrying insurance on something that you've already reached the 20% down payment, okay? I know a lot of you are looking at me kind of strange because you may not have known that, and they don't tell you that. But you can reach out to your mortgage company and say, hey, look, I need you to drop the PMI. Okay? All right. So, question? I'm sorry.
Hello. All right. Good evening. I'm sorry, I kind of missed what you said about the PMI. Is that for FHA loans or conventional loans?
It depends on who you're getting your loan through, but generally, they're going to require a 20% down payment to not have to pay the PMI, whether it be conventional or FHA. But there are some FHA programs that will say, just put 3.5% down, and you won't get charged the PMI. But you need to check to make sure that it's not part of your overall number that you're paying for your mortgage.
Got it. Okay. Thank you.
Okay, so I have a house and I have a mortgage. And my mortgage company has changed hands, not by my, choice, over the years. So in the course of that, how does, I still need to look and check up on the PMI every time, or?
No, what happens is even if your loan is sold multiple times, because that's basically what they do with real estate, they repackage it. The only thing that you have to do is once you get to that 20%, you just contact them the one time. They they remove the PMI insurance, and then no matter who picks it up, it won't be part of your mortgage payment. Okay? So let's go to the next scenario. This is another housing decision. So we're going to go ahead and start the vote. Now, this is really talking about how are you going to handle a down payment for a new house. Got a little over 60 seconds. A little over 30 seconds, and it will close the vote. It's going to be evaluated. 13 people have voted.
One participant voted to keep renting and save up more, while 12 of you chose to buy a house within your budget. That's a clear leaning toward a cautious, responsible purchase. 21 folks didn't vote this round, so the group majority, buying within budget, applies to their numbers. Each voter's choice sticks to their own finances. On average, you're stepping into homeownership with over $330,000 in debt, but a solid credit score of 711. Remember, buying within your means isn't just about numbers. It's about avoiding a financial trap that can feel like a millstone around your neck instead of a foundation under your feet. Think about this. What's one step you can take right now to keep your housing decision aligned with long-term financial peace?
So I have a question. When it talks about buying a house within your budget, what does that mean? Can anybody answer that question? What does it mean when you're talking about buying a house within your budget?
Even though the banks may tell you you are qualified to buy a $200,000 house, but if your debt to income ratio is not going to allow you to pay a mortgage on a property of that amount, you would take what your present outline or budget is. And in my mind, if I was renting, I would see if the amount that I'm actually renting at is comfortable. If it requires maybe an additional $100 to be put towards that, then I would buy according to my budget and not according to what I qualify for.
Okay. Anything else that we should consider when we're buying a house, when we're talking about budgeting for a house? No takers on that one, okay.
I was thinking more like exactly what she said. When I was approved, I did not go to the top dollar amount that I was eligible for my mortgage. When I was looking for a house, I stayed under, I think. And, but I remember renting an apartment and the rates kept going up and up and up. So if you're renting and saving and the rent fee is changing, it's kind of slippery, you know, and frustrating. At least if you're within your budget, you can allocate and put away more, you know, for your emergency fund and everything else. So,
Okay. So both of those are good observations, but something else that you should consider. Remember, when you're renting, there are certain things that are taken care of in a renting situation. So when you're buying a house, to your points, if you can qualify for $300,000, but you want to buy even at $200,000, you also need to take into account all of those extra things you're going to be paying, like your gas, your electric. You need an emergency fund, you know, just in case your appliances go out. You want to buy a home warranty plan that will cover some of those things in the event that they go out. So when you're thinking about buying a house, you're first thinking about, okay, what's the down payment going to be on the house that I can afford to get? But then what's your guesstimate going to be on all of the utilities that are going to be associated with that particular home? What about lawn care and the things that you don't think about when you're renting? HOA. I mean, all of those things need to be part of your overall number, because you can literally get in a house and be able to afford the mortgage, but now you're house poor because you can't afford to pay anything else in that house. And so it's important that you when you buy, that you consider all of the other ancillary costs that are associated with that house. Make sense? Okay. I think I've got one more question, and then we need to get into the lesson. So this one. This talks about your mortgage management. This one's a little tricky. Very cautious about voting. Okay. Got some nervous people. They're not wanting to vote. Come on, you got to vote. Got 20 seconds left. You got to vote. I got 3 people that are refusing to vote based on the last numbers. Even with the URL code, she couldn't get it. Then make sure I get her email address.
9 of you chose to refinance at a lower rate, while 3 opted to miss a mortgage payment. That split shows a clear preference for staying current and improving terms, though not everyone agreed. 22 did not vote and will have their numbers adjusted as if they refinanced. Each voter's choice applies individually. Refinancing here means moving from the weight of $326,000 in debt toward breathing room with a better rate. Remember, missing a payment might seem like a pause, but the cost can echo louder than you expect. Credit scores like 714 don't fix themselves. Think about this. What's the long-term cost of pausing payments versus the steady climb of reducing your interest burden?
Okay, so let's talk about refinancing. What does that look like? No, it's not starting over. It's just refinancing your interest rate. But what are some of the pitfalls when you refinance? because they don't do it for free.
Origination fees and closing costs.
Yes. So if you're going to refinance and they say that they're going to refinance you at 3.5%, then you need to tack on those additional charges so that you can understand what that's actually costing you. Sometimes they'll allow you to roll those numbers in to the new mortgage, and now you're increasing your mortgage by whatever the fees are that are associated with it. So if you're going to refinance a house, either have the money already set aside to take care of those fees, or understand that your payment could theoretically go up because they'll roll those fees into the actual loan. The other thing, too, is they generally will do a refinance based on the number of years that you have left on the loan, unless you decide you want to decrease the number of years. Now, that's always a good choice if you can afford the larger payment. So say, for instance, you have a 25-year mortgage and you want to get it down to 15 years. You can refinance for a 15-year loan, but remember, your payment is going to go up. And so if you don't have the money available to pay for the extra payment as far as the mortgage going up, then simply do it yourself with the loan that you already have. And that's just simply adding additional money to the loan that you're already paying against. Because the more you overpay your mortgage and you tell them to apply it to the principal, then that reduces the number of years that's on your loan. So there's two ways to do it. You have to be able to weigh the choice. If you've got the money to refinance and it's going to save you money, then do a refinance as long as you've got the money to take care of the fees. Now, sometimes a bank will give you, origination. They'll allow it to buy down at a certain rate so that you don't have to, say, for instance, you wanted a 3.5%, but they're saying based on your credit, you have to get a 4%. They may say, well, if you pay an extra $1,500, we'll take it down to 3.5%. So make sure you know what you're getting into, I guess, is what I'm saying. Because to refinance is a good thing, especially if you're sitting at 6 or 7%, to go down to 3 or 4%. 2% probably won't come back in a long time with the way the economy is going right now. So the best you could probably hope for is somewhere in the 5s. Okay?
Veronica, origination, that's what you just explained, origination. I don't know if I've heard that term, or it's been a long
With
time.
with an origination fee, all that simply is an administrative fee for them to prepare the paperwork and all of that. That's all it is. Okay, so you had a question? No? Okay. All right, so we are going to get started. A lot of information. If you have questions, certainly slow me down. Okay, so we've already kind of talked about Matthew 13, where it talked about sower of the seeds. So you're going to find that everything that I'm doing in this lesson will follow Matthew 13, because basically that principle, although it's also spiritual, also can be superimposed onto what is financial. So when we think about seeds, it's really every investor begins with a seed. It doesn't matter how big or small your seed is. The key is to actually get started. So every dollar invested, like I said before, is a seed. Seeds may look small, but they contain potential. Investing starts quietly. No fireworks, no big jumps. The beginning is humble but powerful. Your first dollars don't look too impressive. They just look like a seed. But inside the seed is every opportunity for your future needs to be met. And I think we talked about it last week when we talked about the soil. And when you look at the soil, it doesn't look like there's anything in the soil. But as those seeds begin to grow, that is what your investments do. So, what does that mean in real life? Can somebody read that for me? Just what does it mean in real life? Anybody? Any takers? And I'm going to have you guys reading a lot because I want the points to be driven home.
Seeds, first dollars. What it means in real life. A seed is any small, consistent amount of money placed into a savings or investment account. It could be $5, $20, or $50. The size doesn't matter. The habit is the seed. The consistency is the soil. The time is the sunlight. Why it matters? Most people wait until they have more money to start. But the forest doesn't grow because you waited. It grows because you planted.
Okay, stop there. So, what she was saying is basically it's really about getting started. It doesn't matter how much the seed is, it's really about starting a habit. And once you start a habit, whether you make that habit automatic through your banking account, where it will automatically flow into either a high yield account or some other sort of investment account, that's the key. And so what I'd like for you guys to do this week is I want you to go ahead and open your high yield savings accounts if you haven't done those. Because remember, we talked last week about a high yield savings account for your emergency fund. You want to be able to say, yeah, I've got an emergency fund, but I've also got seed money. And that seed money could be for whatever you want to invest in, whether it's real estate for a house, whether it's a Roth IRA or some other investment vehicle, but you at least want to get started. So next week, I'm going to ask the question, how many people have opened up a high yield savings account? We talked about all of the different places that you can open one up, anywhere from 3.5% to about 4%. The online banks, because they have no brick and mortar, are offering a higher rate, but if you like a brick and mortar, look at their rates and see what they're offering. So like we said before, early growth is going to be slow. So it's important not to quit at this stage. Your investments start to stand on their own like a young tree. This is where consistency pays off. So as you can see, it starts small, but as you give it time, it begins to grow. And once the roots are strong, that's when you've got some good investments happening. Then we'll talk about compound interest again. The longer you keep your money in the market, the more it's going to grow its wealth. And it's going to be like the doubling penny that we talked about last week, I believe we talked. And it's really about the time, how long you keep it in the market, not timing the market, but how long are you keeping that investment in the market. So, compound interest. Who's going to read that one?
Forest, compound interest. What it means in real life. Compound interest is when your money earns money, that earned money earns more money, and the cycle repeats automatically. It's the financial version of nature's exponential growth. This is why early seeds matter. This is why staying planted matters. This is why storms don't matter. The forest is the payoff for patience.
So a lot of people underestimate compound interest because it starts slow. But once it accelerates, it becomes the most powerful force in personal finance. Compound interest rewards early action. It magnifies consistency. It multiplies long-term discipline and turns small beginnings into massive outcomes. It's not magic, it's math. And most people that know me will either say that I am very systematic, very methodical, and math is methodical. as long as you follow the principles of math, you know that your money's going to grow just kind of based on the way that the stock market, index funds, and all of those things happen. So if it's going to pay you anywhere at 6% when the market is flat, it makes better sense to keep it there at 6% than trying to pull it out because you fear the storm. So your action steps you want to take this week. I want you guys to use a compound interest calculator. What that will do is I want you to be able to put in an 8% annual return at 10 years, 20 years, and 30 years. And you'll be able to see exponentially how it's growing based on the number of years that you're leaving it in there. Then I want you to write a sentence, my forest grows because I stay planted. And I'm going to keep hitting that point home. But I want you to take advantage of looking at that. All you have to do is to go into a compound interest calculator, which you can find by literally going into Google, saying compound interest calculator, pull it up, and put in your terms in there, 10 years, 20 years, and 30 years. The reason I used 8% is because the market is doing extremely well right now. So 8% is pretty modest. Everybody got it? Storms over a growing tree. Storms represent market drops, fear, and volatility. The tree represents your long-term investments. Storms shake branches, but don't stop growth. The sun returning symbolizes recovery. Markets historically rebound. Emotional reactions like panic selling cause more damage than the storms themselves. So we understand why I say that, right? Questions? What is market volatility? Anybody want to read that?
What is market volatility? Prices are moving, emotions are high, the market is reacting, opportunities may appear. Staying planted matters more than predicting storms.
So, does everybody understand that volatility is going to happen? It's just whatever your posture is while it's happening. So once you go from understanding what it is, this is what it isn't. So who wants to read that?
What volatility doesn't mean. Volatility does not mean your investment is broken, the market is failing. You should panic. You should sell. Storms don't mean the forest is dying. They mean weather is happening.
So when we look at this depiction of a tree, and this is just not fake. I mean, you can go to any beach and you can see a tree leaning all the way over. You can see when the wind blows, the branches may move, some of the leaves may blow off, but at the end of the day, the roots are so strong that even though it's changed its position from vertical to almost horizontal, it's still growing. It's still green. It's not dead. And so market volatility is the same way. It's going to move. You're going to have emotions about it. One of the things I tell people when you're investing is if you're a person that is risk averse, don't look at it. Look at it once a quarter, look at it twice a year, whatever you need to do so that you're not tempted to pull your money out. So what does it mean in real life? Nicole, go ahead.
What it means in real life. Volatility is simply price movement. Stocks going up and down. It's normal. It's expected. It's part of the weather of investing. Most beginners think volatility means something is wrong.
But volatility is just the market reacting to news, emotions, and global events. It's not a panic signal. It's a signal to stay planted. Why it matters. If you don't understand volatility, you will panic during drops, sell at the worst time, miss the recovery, sabotage long-term growth. Understanding storms is how you teach them to stay calm and stay invested.
Okay, stay right there. So, how many of you really understand how just words spoken can change the direction of the stock market? President Trump is a perfect example of that. He can speak something today and the market will dip. He can speak something different tomorrow and the market will rise. And so the trick about investing is you buy at the dip. You buy when it's low because you know it's going to rise. And so volatility can be controlled by a war like, the Strait of Hormuz. It could be Venezuela. It can be, an earthquake. It can be anything that affects the market. You just have to be calm in the market, know when to buy, but don't sell. When to buy, but don't sell. You've got to stay planted. So your action step this week is to look at a one-year chart on the S&P 500 NASDAQ. You can look at any index fund, and you can look at it on your stock. I'm sure most of you have stock on your phone, and you can pull up the S&P 500. You can look at it for a period of 1 year, 3 years, 5 years, 10 years, and you will see that it's going like this. Sometimes it's going straight up because it will start here with a penny stock and then go $300 or $400. So the reason I want you to look at that is because, again, it's about long term. It's not about buying a vanity stock and then, wanting to dump it because the vanity stock is failing or you think it's failing. SpaceX is a perfect example. SpaceX opened up and they had some investors that were able to get stocks at $125 before the market opened. And then once the market opened, because it was an IPO, it shot up and then it tanked like $113. Now it's back up to about $135. So just because it tanked, if you were buying it at $113, you would have made a profit on that same stock that you thought was failing, okay? I'm not going to talk about stocks today because stocks take real time to really research them because you want to make sure that the company's P&E is strong. You don't want to buy a stock just because they're a strong name in the market because their back end may not necessarily be strong, okay? So what we're going to talk about today is two paths. You've got the path of the shelter grove or the open meadow. Anybody want to talk on that? Somebody back there. Picture. Either one. Yeah. Or you can just summarize it so that I understand that you know what it means.
Two paths, Shelter Grove versus Open Meadow. Shelter Grove, safety and stability, represents security and caution like keeping money in cash or savings. The grove is shaded and still. Trees stand close together, blocking wind and sunlight. It feels safe, predictable, and familiar. But growth here is slow, the soil is rich, but the light is limited. Open meadow, opportunity and growth, represents investing, open, bright, and full of potential. The meadow is uncertain, storms may come, winds may shift, yet sunlight fuels faster growth.
Okay, we can stop there. So this is what's talking about risk aversion. It's normal. It's human. In the forest, we all choose where to plant our seeds so that our roots can grow. Some prefer the calm of the grove, and some prefer the open meadow. Most people choose the safe path because the unknown is scary. But again, if you stay in the shelter of the grove by putting your money either in cash underneath your mattress, is basically what you're doing, because it's not growing. It's just money with no interest attached to it. And then you can put it into savings. If you put it in a regular savings account, you're making less than 0.25%. And so this represents, when I think about the Bible, when it talks about shelter grove, that reminds me of the tale of the talents, where you had one that had one talent, and because he was fearful, even though he knew the master would want at least usury on that money, and he failed to even put it in the bank, it was like putting it under your mattress. He didn't make a dime. And so what you want to do is you want to make smart decisions when it comes to investing, but you have to do it based on your risk aversion, okay? So the forest floor represents your checking, savings, CDs, money markets, savings bonds. Those things are deep roots in shade. They make a minimal amount of money on your money, but it's slow and it's protected. You're not going to get huge swings on it because it's pretty steady. The understory is moderate risk. There are certain types of bonds, mutual funds, index funds, real estate. Those are balanced exposure. Those are things that are going to make you money, but it's not going to be high risk. It's going to be those things that are well balanced. And then you'll get to the point of where you're talking about stocks, options, futures, collectibles. Those things are high volatility, but huge returns. But those aren't things that you play with if you don't have money to enter into those particular markets. So, risk aversion is the instinct to protect your money. Protection is good, but too much protection stops the growth. Okay? The storm tests the forest. Staying planted is what allows it to rise again. So that looks pretty scary as a storm. But remember, the storms always end. They don't stay. And historically, when you think about the stock market, whether you're buying mutual funds, exchange-traded funds, the market will fluctuate. It's whether or not you have the staying power in order to have your money work for you. Risk aversion. Who's going to read this one?
I can't see. No, man, I don't have my glasses.
Protection. Risk aversion. Risk aversion shows up when people, one, keep all their money in cash, avoid investing because it feels scary, freeze during market downturns, choose, quote, safe options even when they limit growth. It's not wrong, it's human. But staying in the cabin forever means you will never explore the forest. Risk aversion is simply your emotional tolerance for uncertainty. Understanding it helps you to choose investments that match your comfort level.
So if we took a poll in the room, how many people are truly risk averse? Everybody else is comfortable? You're risk averse as well? Okay, so when we talk about risk aversion, to what level are you risk averse?
As far as, well, that first bullet throwing me off a little bit. Keep all their money in cash, because I don't do that though. So I would say.
But it could be other things. You can have a regular checking account or a regular savings account because you're afraid to move it out of that.
I mean, I have investment accounts like S&Ps and all that kind of stuff. But even with those, I advise my financial planner that I didn't want to do the real risky stuff.
And what do you consider real risky?
That volatile market, the up and down, it's like, I like being able to see exactly where it is. I like the consistency of it.
So does your financial planner have you in things like bonds?
Yeah, I got a couple.
And what's your horizon? More than 10 years?
That's a good question.
How many more years are you going to work?
Wait. I only want to, how old am I? Yeah, look, girl, I had to ask myself, I stopped counting. That's a good question. I haven't really thought
Is it
about
more than 10?
Nah, it's not more than 10.
So it's less, is it less than 5?
It may be about 6.
And so for the last however many years, you've been safe vehicles like bonds.
Mm-hmm.
And you know the story on bonds, right? We're going to talk about bonds next week, but bonds,
Maybe going away.
4%, maybe 6% if you're lucky, depending upon what type of bond you're purchasing.
Mm-hmm.
So you've been making the bare minimum for the last 15 years,
Yeah.
20 years?
Yeah.
So when you look at your statement, from where you started to now, your growth is minimal, right?
There's so many, probably so, but I need to do better.
Yes, ma'am, that's the point.
Mm-hmm.
Because risk aversion will put you in a situation where you're paralyzed and you don't do anything.
Mm-hmm.
There are other safe vehicles other than bonds where you can still make a moderate amount on your money, but bonds is like a safety net. It's after you've made all of the money that you want to make based on your horizon, and bonds just kind of come in and underpin everything to kind of make sure that now you're in money management or maintenance versus accumulation. Okay? So, why does it matter? Okay, Belinda, go ahead.
Okay. I was getting ready to hit Minister over there, but
Oh, you know what? You can hit her too. But I
I'll
think
hit her
she-
on the next one. She's eating some grapes right now.
Okay.
Why it matters. If you don't understand risk aversion, you will. Pick investments that feel too scary. Panic during volatility. Sell at the wrong time. Avoid opportunities that fit their goals. Protection is important, but it must be balanced with growth. Action step you can take this week. Write down one financial choice you've avoided because it felt risky. Then answer this question. What part of this feels unsafe? The money, the uncertainty, or the unfamiliarity? This helps identify whether the fear is emotional, informational, or truly financial. Once they name the fear, you can manage it, not be ruled by it.
And that's the important part. Once you're able to identify what it is that you're fearful of and you put a name to it, there are certain things that you can do to bring that fear down. So say, for instance, your fear is based on emotion. Well, what is the root of the emotion? Because you saw somebody else maybe lose money in the market and now you're fearful? That may not be the right, frame of mind when you're thinking about investing. But what if it's informational? What if somebody gives you a tip and they give you all of the pros and cons about the tip, but they haven't really did the investigation on it. And you're taking their word for what that particular investment is. If you just take a few moments to do the research yourself, you may find whatever you're fearful of is not even valid. So when you're thinking about investments, put a name to it. If it's fear, ask God, why are you fearful? If it's something that you've heard, is that thing that you heard true? If it's truly financial, what I hear you saying is because you don't want to lose money because you're close to the end of your horizon, then you still have to make sure that the money that you've saved and the investments that you're making are going to last until your retirement phase is gone, meaning you leave this earth. So if you've only got $100,000 in your savings and you're going to live another 20 years, is that $100,000 with Social Security going to take you through another 20 years? And the answer to that is probably no. And will Social Security be here in another 20 years? The answer to that is probably no, because it's been mismanaged. And unless they make some significant changes, which I don't think that they will, that money's not going to be there. So you have to make sure that when you are saving for your future, you're thinking about all of the things that will happen when you're no longer making money. You're going to have medical bills. Even though you may get Medicare, there are fees associated with that they pull out of your Social Security. So there are a lot of things that you're going to have to consider based on the way of life that you want to live once you're no longer working. So stay planted. And this is going to get you to where you need to be. Your job isn't to predict the storm, it's to stay planted. And time in the market beats timing in the market. So, steady growth. What does it mean?
Tree, steady growth. What it means in real life. Steady growth is what happens when you invest in assets that grow gradually, compound over time, don't require constant monitoring, reward patience. This includes things like broad market index funds, employer retirement accounts, or diversified portfolios, anything designed to rise slowly and consistently over years. It's the opposite of chasing quick wins. It's choosing slow, predictable progress over hype. Why it matters. Most people want their money to grow fast, but fast growth is unstable, emotional, and often unsustainable. Steady growth is what builds confidence, resilience, long-term wealth, peace of mind. Trees don't panic during storms. They keep growing.
So your action steps are going to be to look at a 10-year chart of the broad market index fund, like the S&P 500. Notice how the lines move, not straight, not perfect, but steadily upward. Write down one sentence. My goal is steady growth, not fast growth. And why is fast growth not good? Sometimes it can be good, but why is it not good overall? Because one, if you haven't learned how to manage fast growth, you're going to lose it anyway. But also, when it's fast, sometimes underneath that fast growth is unstable foundation. And so a company may skyrocket up and they give you huge returns on your money when you first invest in that particular stock or mutual fund, but then something happens and that company goes awry. And all of a sudden, it plummets. Now the wealth that you thought you had is no longer there. And so it's best to take your time and choose things that first fit your aversion of risk and secondarily are going to meet your goals as far as how much you want to make on your investments. Markets, again, they're going to be downturns. So staying planted. In real life, staying planted means continuing to invest consistently, not selling out of fear, trusting long-term strategy over short-term emotion, and letting time do the heavy lifting. I'm going to go past this because I think we need to go ahead and get into the actual funds. So I'm going to first talk about diversification. It may feel like you're walking on a narrow bridge, but diversification really kind of steadies that. And we're getting ready to talk about the 3 types of funds that you can start to invest in pretty quickly that are going to give you the diversification that you need. I'm going to go past this. If anybody wants this slide, I can go ahead and forward it, or you can take a picture of it. But I want to kind of get into, because we only have about 30 minutes left. Three paths, one forest. So first you've got your index funds. Those are mapped out, they're guided, and I'll go into the definition of that. Then you've got your mutual funds. These are selected by a fund manager. And then you've got ETFs, which are funds that kind of act like a single stock, but they come in a group, and you can kind of move them like you would move a stock. So you've seen the 3 paths. Now we're going to kind of talk about what they mean. So an index fund is nothing more than, let's just say they're a group of seeds. And basically what it does is it takes multiple companies and it groups those companies together, and you can buy that index fund, and it's generally going to be based on, the S&P 500 or the Russell 2000, but in any event, it's going to be several companies. They're going to be comprised of different industries. It can be anything from, finance to healthcare to retail. But basically what happens is, because it's not on a single stock, if one stock fails within that grouping, you still are diversified in such a way to where you're not going to lose all of your money. So this is a safe bet, because the market is going to do what the market is going to do, but some of the stocks within that index fund are going to rise. Even if some of them dip, you're still going to make money on your index funds. And right now, they're doing pretty good. So, again, it's a whole forest of companies growing together, not one stock, not a handful of stocks, but a full ecosystem of hundreds or thousands of businesses. Any questions about an index fund and what that is? So from seeds to selection, you've seen basically what an index fund is. And if we have another class and you want to go deeper, we'll go deeper into what they are, but I'm just mainly giving you an overview. So a mutual fund is a little different. It's the same thing. It's got hundreds of companies within it, but it's managed by a fund manager. And basically the job of the fund manager is really to pick the right stocks of companies, group them together so that he creates or she creates a mutual fund. And basically they're paid a fee in order for that to happen. Questions? It's the fund manager. So this kind of breaks it down as if you're talking about a gardener's basket. It's like a basket of trees where he picks the ones that he wants to group together. There are hundreds and thousands of different mutual funds that you can purchase. And so once you decide which type of mutual fund you want to purchase, then he is responsible for managing that fund. Sometimes what will happen is things within a mutual fund may not be performing at the level he wants them to perform. So he may pull that particular company out and replace it with another company to keep the mutual fund balanced. So they study the market and they guide it. The next is going to be your ETFs. Now this one gives you the most flexibility because it acts almost like a stock. So you've got hundreds of companies within it, and it comes, you can buy it as a ETF fund, exchange traded fund. And basically, with these funds, you can treat them like a stock. So you can literally buy an ETF in the morning, and if you're a day trader and you decide you want to sell it because it's on the uprise and you want to take the profit out of it, you can literally sell that ETF in the evening and make your profit on it. I wouldn't suggest you do it that way because day trading is a monster in and of itself. But it does move that way so that you can literally buy it and get rid of it at will. So, what about the expense ratio? So again, when we're talking about things like index funds, they're anywhere from 0.3% to 0.7% annually. So cost per 10,000 on an index fund can be anywhere from $3 to $7 a year. So you see that those are very low costs when it comes to expense ratios. Mutual funds, because they're taken care of by a fund manager, are going to be anywhere from 0.5% to 1%. So at a $10,000 increment, it can be anywhere from $50 to $100. So it's a significant difference between an index fund and what you would be charged for a mutual fund. But remember, these are annual fees. So in the grand scheme of things, $50 to $100 to have somebody manage it for you is not a whole lot of money. When we talk about ETFs, those are similar to the fees that you would do for an index fund. Maybe slightly higher, so it might be anywhere from $3 to $10 per 10,000. Any questions? I know I'm going through pretty quickly. So, this is almost my last slide. So, we see to the left, those represent your storms. That's volatility. Then protection is the little shelter there. And that's really your risk aversion. That's where you decide how you're going to package your investments so that you're sheltered from the storm. Then you've got the seeds, which are going to be your first dollars, which you guys are going to do this week. You guys are going to start moving money into an account so that you can start to invest those funds. Then we're going to let it steadily grow. From there, the forest compound interest is going to make it grow exponentially. So the things that we have to remember when we're talking about the garden of our investments is, one, first determine how risk averse you are. Once you determine that, then choose the vehicle that is best suited for you. If you're a hands-off investor and you don't want to look at it, you don't want to do the research, mutual funds may be your best. You can get a rating on the mutual funds by Morningstar or any of the other ones. They'll tell you how much those funds are rated, and you can buy the funds based on that. Or you can look at the mix on that particular mutual fund. So if you're leaning towards healthcare or energy or anything like that, you can look at what's comprising that mutual fund and decide to do that. Also look at, your 3-year, your 1-year, your 5-year, your 10-year. How well is it doing over time? So you know basically how your money's going to grow. There are ones that are high volatility that you're going to make a lot of money on, but you need to be able to look at the dips and the rises in it and make sure that your horizon is long enough in order to withstand the storms. So when I talk about horizon, do you understand what the horizon is? You understand what the horizon is? Yes, ma'am? You're going to tell me what that is? She's coming with the microphone.
Right here? Right.
Over here. This way. You just answered off the top of your head. What's your horizon? When I say you look at your horizon.
You look at, I guess, based off of your finances, what you are able to invest, or like what is going to be the most that you will invest based off of also like you're determining how risk adverse you are?
Horizon's a little bit different than that. Horizon is really your timeline. That's all it is. And so if you're in your 20s or your 30s, you've got a 30 to 40-year horizon. And so when we're talking about the ups and downs of the market, you're going to make a lot of money if you stay planted, if you continually to do your investments. But say you've only got 20 years left on your horizon. You still, I'm pretty aggressive, so I'm going to go into things that are super aggressive because I'm not risk averse. So I'm going to allow my money to grow at a higher rate. But say you only have 3 to 5 years and you're like, I'm at the end of my growth horizon, then you may want to do a mix of either mutual funds, index funds, bonds, things that are going to be safe so that you don't lose your money, especially when the economy gets a little bit rocky. It's going to get rocky. So if you don't have a long timeline, then you may make a different mix as far as how you're going to invest. Any questions? No? No questions? I went through that pretty fast. Wow. Okay, so no questions. So my last slide, staying planted. It's literally staying planted. So I started this course by saying, when we started today, that when you look at Matthew 13 and it talks about the seed from the sower, can you see the correlation here when we talk about investing? It's the same. Whether you have shallow soil, whether you have rocky soil, or whether you have rich soil, that's going to be the indicator of how well your investments are going to grow. Okay? You guys ready for a couple more scenario votes, or you guys want to ask some additional questions? No questions?
I don't know if this fits in what we're talking about now, but what about investment apps? What do you think about those? I have Robinhood.
Investment apps.
And I put something in it. I don't really do a lot.
Are you talking about Robinhood?
Yes.
Okay. So when you talk about investment apps, you're buying slices. You're not buying a full share of a stock. So I'm not a big fan of that, because when you try to pull your money out, what are you pulling out? You're pulling out slices, so you don't really own anything. And then you have to be mindful of if they're charging fees within that app. I'm not a big fan of Robinhood, but you know, if that's your entry into investing, then start there very small. I wouldn't go any more than a few $100s if you're going to do it, and then graduate from baby steps into an index fund, a mutual fund, an ETF, because that's going to make you more money than buying slices of a share. Is what I would do. Any other questions?
Okay, so if you have an IRA and it's managed, and I guess it's a funds manager that's taking care of it, and they just ask every year, you know, when we meet, do you want, you know, moderate risk, high risk, whatever, but you don't really give any input about the mix. It's just whatever the ETFs, the mutual funds, the index funds. I don't know. So I guess in comparison to Peyton's question, so like I have a Merrill Edge account, because I'm not, that's not my area of expertise. I just want to set it and forget it and let them do whatever, or should we want to have more input? Because someone said to me, unless you are, someone that's got a lot of money, they don't really care to grow your money, and that's not a good thing to do. So I don't know.
Okay, so there's a couple of ways that I can answer that. So normally when you're talking about a company 401k, they allow you to do it 2 or 3 different ways. The first way is they'll say, hey, do you want to be in a targeted account? And your targeted accounts are ones that are based on age and the year that you're going to retire. Those have a heavy fee associated with them, because what they do is, depending on your age, they will start out very aggressive, then they will go midway, and then they will be heavily in bonds. Don't like those because the fees that are associated with those are pretty high. Then they'll do like your account. They'll say, what sort of asset allocation do you want? Do you want a very risky one? Do you want a moderate one? Or do you want a safe one? But you still have the ability to look at the asset allocation. All you have to do is say, hey, I want to see what the allocations are for the moderate. And the moderate may be mutual funds that are in pretty safe industries like healthcare or energy or something like that may pay dividends within that asset allocation. So you can ask that. The other thing that you want to consider when we talk about your horizon is, does your company offer the Roth IRA as well? Because one of the things that you have to be mindful of with a 401k is it's pre-tax, which means that when you're ready to retire, depending upon what tax bracket you're in, that's normal income. So if you take $20,000 out of your 401k, you're going to have to pay taxes on that money because it's pre-tax money at whatever rate you're at. So if you're sitting anywhere from 24, 27, 32, 37%, that's what you're going to be charged when you're taking money at 59.5. If you take it then, or if you wait to when you have to take it at 73. So the thing that you want to consider for both young and older people is starting to use the Roth IRA, because the Roth IRA is post-tax. You've already paid tax on it. So the beauty about the Roth IRA and the conversion from the 401k into the Roth IRA is it gives you the benefit of having your money grow. Everything, the principal and the growth, is tax exempt. You never have to worry about paying taxes on that money. So if you're building a legacy, I would leave the one that's pre-tax to whoever you're leaving it to, because then they would have to pay at whatever their tax rate is. But if you don't want to leave people in a situation where they're having to deal with the taxes on a pre-tax account, begin to roll it over. So if you're at the end of where you're ready to retire, then you'll probably drop into the low to the mid-20s as far as your income tax bracket. You'll pay up to, say for instance, I think the 24 is somewhere around, you can make anywhere from, $403,000 as a single person. So what you want to be able to do is you want to convert at the top of that 24% or the 27% and pay taxes on it and just roll it into the Roth. If you're young, do both, a Roth and a 401k. If you're still in the workplace and you still have a horizon, do both. You want to do both because you want to start getting to the point of where you do the match in the 401k because they're going to do it in pre-tax dollars, but then take any extras that you make. So if you get a raise of 3% every year, move that extra money into the Roth instead of the pre-tax, okay? Any other questions?
question about what you think about annuities and if they are a better vehicle maybe than some
What
of
was
the
the
other
first thing
options.
that you said?
Annuities.
Annuities can be tricky
Okay.
because annuities, they have super, super high fees. And so there aren't many out there that are low fees and you actually make money on. So if you're thinking about an annuity, but at your age, an annuity is probably not a good option. But if you're thinking annuity, you want to see what the fees are because they front load it. And that means they get all of their money first before you even start making money on an annuity. Okay? I think there was a question in the back.
Okay, so I had a question about the Roth account. I remember speaking to a financial advisor, and he informed me, I guess, well, this was with Fidelity. He said there's two different types of accounts. There's a settlement fund account, and that's when you don't invest.
Right.
If
It
you
just
don't-
sits there at 3 or 4%.
Right. Well, at this time, he said it was 1.75%. It is covered by the FDIC, but your money doesn't grow, right? I think that was kind of pointless. But then if you put your money in a Cash Plus account, it's covered by the SIPC, right? But that's the money market, which you could, your money can grow possibly about 3.59%. However, your money, you still have to invest into stocks.
No,
in order
that
for your
part's
money-
not true.
That's not true? Okay.
Okay, so that was the account that I was talking about last week. So basically what happens is it's dollar for dollar, but it pays you at 3.5%, some of them are 4%, and it's like the Vanguard one. So basically what it is you put your money in, and it's like a mutual fund, but it's not buying any fund. It's like dollar for dollar, but they pay you interest on it. So the way it works is like you're loaning money to people that need to borrow money. So it's like you're a lender, but then you make 3 to 4% on your money for lending it. Now, when you're ready to liquidate that, you just have to sell those shares, which are dollar for dollar plus your interest, to get the money out. The difference between that and the first account that you talked about, one is just a settlement savings account. Fidelity is paying lower than, say, a Vanguard, but it's paying higher than if you kept it in a regular bank. Does that make sense? So you're like a lender when you're talking about that other account. Okay? Any other questions? No? Okay. Okay. So a regular IRA is pre-tax, and that's generally going to be through your employer, because what they do is they take the money out of your check before they actually assess the taxes for it. So that's why when you're talking about pre-tax dollars in your 401k, you eventually have to pay the piper with the taxes when you withdraw the money out. The Roth is different because that's money that you've already paid taxes on. So it would almost be like you get your paycheck and you decide that you want to invest the money in a Roth IRA. You would take the money that's already been taxed and put it into the Roth IRA. So some companies today are offering both, where they'll take the pre-tax dollars first, and then once they tax your paycheck, then they'll take whatever percentage you want in the Roth IRA. Any other questions? Yes, ma'am.
For our homework this week, what are some suggestions for a high yield savings account? What would you suggest as far as high yield savings?
So when you're talking about big box banks, they're not going to give you a high yield account. So when you're talking about Wells Fargo, B of A, and all of those, you're not going to get it there. So if you don't have a credit union that may offer a high yield savings account, then you want to go either with an online bank or you can actually put the money in Vanguard, Fidelity, Schwab. They all have high interest accounts. And I would suggest, if you're talking about investing eventually, use one of those three, because your money will grow until you're ready to invest it.
I have opened up a Vanguard Cash Plus account and put an amount of money in there. And I have my regular savings and I have my emergency fund. So should I start moving my savings over there or splitting half of what I put in savings and leave it there in savings and the other half in Vanguard to feed it every month or every pay period, or?
Okay, so what I hear you saying is you have a savings account in your regular bank, and you also have your emergency fund in your regular bank.
Yes.
Move it.
Move
All of it.
both of those accounts?
All of it. Because what are you making in your savings account? It's probably pennies, right?
It is.
So you want to move all of your money into a high yield account, and you can earmark it to where you know how much is your emergency and how much is just going to be your regular savings. Because in the Vanguard account right now, it's paying 3.35%. And so you want to be able to make money on your money, and it's still liquid. It's not like you're going to have to, figure out how to get it out. Because it transfers pretty easy between the bank. All you have to do is link your bank. Any other questions? None?
How do you feel about SoFi? I mean, because I opened a SoFi account, and I know that you can even, get into investing. So, savings, checking, and investing. I haven't really done anything with it, but opened it.
Okay. So SoFi was originally opened up as an app to be able to get people that had school loans to refinance those school loans. And so when you're talking about using an app from an industry that was literally talking about loans that were deferred or whatever from a school situation, you have to weigh the pros and cons on, do they have enough underpinnings to support investments and things like that? Or do you want to go with a company that has a long history and that's their core competency? SoFi, that's not their core competency. Their core competency is really, taking care of loans from educational loans. But I'd take a look at it and see. I mean, I've seen a lot of advertisements to kind of get people to move things over there, but I would really take a look at it to kind of make sure that that's where you want to do your investing. Any other questions? Okay. I think we've got maybe time for one more scenario. No, I don't think we do. Yeah, we don't have time. So what I'm going to do now is I'm going to engage Marcus so that he can do the final teaching moment.
You've already been given everything you need to change your financial life: the structure, the strategies, the clarity, the foundation. But knowledge doesn't build wealth. Action does. And the only thing standing between where you are and where you want to be is whether you decide to use what's already in your hands. Obstacles will always show up. But obstacles aren't stop signs. They're navigation points. They're the places where you choose whether to pause or to push forward. So here's your moment of truth. Are your obstacles really the problem, or is the real barrier your willingness to move anyway? Because once you move, your wealth has room to grow.
So the question that he's asking is it fear that's keeping you from making good decisions about where you want to be financially, or is there some other obstacle? So that's what you need to think about this week, because as we get into next week, we're going to dive a little deeper into investments, but we're going to talk about those safe havens. And it doesn't look like anybody in this room really needs the safe havens, but we're going to talk about the safe havens. And those are things like bonds, municipal bonds or corporate bonds. We're going to talk about insurance. You know, what type of insurance should you buy? Should you buy universal life insurance? Should you buy a whole life policy that you can borrow against? But there are some tricks with that as well. Or do you buy a life insurance policy to make it easier on the people that you leave behind? So those are the things that we'll talk about next week. That will wrap up the session here. There's so much more that I can teach, but there's not enough time to teach it. So if any of you have specific questions or concerns about a particular type of vehicle that I'm not covering, you can certainly reach out on the email address that I've already provided. So, Minister Cece, if I can ask you to pray for us out.